have you bought any shares in SpaceX?
Oh, I haven't.
You haven't?
I haven't.
No.
My son did say to me, Dad, if you think it's so overvalued, why aren't you going short? And so I had to explain market momentum to him and how much it could cost me before that short works.
I'm Dylan Lobo and welcome to Heart of Wealth, your weekly pulse check on the wealth industry. Today, we're unpacking a regulatory nightmare, private credit fears, and a mega IPO. Here are today's headlines. Rathbones Rocked. FCA probe triggers a 17% share price crash. Credit Peril. Wealth chiefs warn of a mis-selling backlash. And finally, SpaceX dilemma 1.8 trillion IPO gives passives an identity crisis. Joining me are Citywire journalists Jeremy Gordon and Celine Boujak, alongside former Morningstar CIO Dan Kemp, who has just launched his own investment consultancy.
Morning, Dylan.
Morning. Thanks for joining us. It's been a quiet week. Not much has happened, has it? Apart from Rathbones. So let's start with our first story, Jeremy. Rathbones rocked by FCA intervention. Tell us a bit more.
Yeah, so this is, I think it's fair to say, quite a shocking announcement on Tuesday morning. So Rathbones announced to the market it's had to undertake a skilled person review. The FCA's made it do that, better known as a Section 166. Why has it had to do that? What's gone wrong? Well, I think there have been some compliance failures and also some shortcomings on consumer duty, the FCA's kind of regulatory framework to make sure consumers are receiving what it calls good outcomes. So what's happening? Well, Rathbones says it's got to undertake a 2-year program to kind of sort some of these things out. It's going to cost it about 60 million to do so. And there's quite a few things within that. One area is it's freezing taking on new enhanced due diligence clients, so higher risk clients which might have concerns about money laundering or might have some kind of overseas connection or that kind of thing. It's also reviewing its client bank, or at least part of its client bank, to see whether it's meeting consumer duty, and it's also stopping charging investment management fees on client cash. And yeah, all round it was a big shock in the industry.
Yeah, I mean, there's a lot of stuff going on there, isn't there? Dan, what were you thinking when you were reading this story?
It's bad news for Rathbones, let's be clear, but there's a broader good news story here. The good news is that consumer duty is not just a bureaucratic tick boxes exercise. It has teeth. The FCA are making sure that they are focused on outcomes. I can't believe that Rathbones will be the last to be looked at in this way. It's a very large, complicated business now. It's had lots of acquisitions, and so there will be lots of things to look at. But the good news is for consumers that the FCA is actually focusing on this. They are putting their enforcement where their mouth is, let's say, and making sure that there are good outcomes for investors.
So is this a warning for other consolidators out there?
Well, it is a warning for other consolidators that when you're taking on businesses very quickly, and we've seen that a lot, then you're bringing together IT systems, compliance systems, culture, finance, all these things, and it's difficult to stitch it all together quickly and seamlessly. And so I think there's a lot of other wealth CEOs out there today thinking not, oh, great, Rathbones are kind of competitor has been fine. There'll be more thinking, what is it about our business that we need to worry about?
Right. Maybe one other thing we can say is, so, Rathbones and Investex UK Wealth Business merged in 2023. I mean, that's taken a huge amount of energy and focus to integrate that. There have been cuts to staff, while they find, synergies, operations people probably let go. A lot of the top team has turned over under new CEO Jonathan Sorrell. So that's probably taken a lot of energy. At the same time as the firm has had to implement consumer duty. And so, maybe it's not surprising that, it's been difficult to bring it all together.
Okay. I think we could dedicate the whole show to Rathbones, but we should probably move on.
Shall we?
Shall we? No, I think we need to include Celine here. The Credit Peril, which is, maybe, an equally worrying story, perhaps. I don't know. So, Celine, you just returned from Super Return Berlin. Where Extinction Rebellion protesters literally filled the streets with pink smoke outside the venue. So, tell us a bit more.
Yeah, it was a very interesting vibe at the conference. A lot of people inside weren't actually aware of the protests. They saw the police and like, why is the police here? And the discussions revolved around the private credit funds in the US, limiting redemption, seeing increase in withdrawal requests, and then also on the more institutional side of things as well, portfolios being stuck with a lot of companies that they haven't sold and they haven't returned capital to investors. So those were the main talking points.
There were a few parties, right?
There were parties. There are always parties, but the mood was not very positive. To be honest, compared to last year, there was a lot of animal spirits. People wanted to do deals, and they were excited about the markets generally. And this was a lot more subdued. There were concerns being raised. Just where the market is, everyone's a bit uncertain where things are headed.
Well, it's been a big subject on Citywire, private credit this year. And we had some CIOs from private banks and some CEOs from asset managers interviewed for summits. And they had quite differing views. So the CEOs, the asset management CEOs, were a bit more, let's say, I wouldn't say relaxed, but they just felt it was a US-specific problem, whereas the CIOs, the private bank CIOs, they didn't hold back. They just said, this is mis-selling. So Dan, which side of the fence do you sit on?
Or sit on the fence. Yeah.
Or are you sitting on the fence?
Yeah, I mean, listen, it is a much bigger issue in the US. But I think that difference of opinion really focuses on or highlights rather, the fact that the CEOs are thinking about their business and risks to their business, whereas CIOs naturally think about the end investor, think about their portfolios, think about the knock-on kind of consequences. It's what being an investor is about. And so I think although they seem like contrasting views, actually they sit pretty comfortably together because we've all heard an enormous amount about private credit. But you're right, the problem with this is that of course you should only take on an illiquid investment if you've got your own liquidity profile to match it. And most people don't think enough about their liquidity profile, and so they think that they're fine. But if a panic starts, then of course you're better off being at the front of that queue than the back. So actually you get penalised typically if you're at the back of the queue, because as people try and sell assets, they typically sell the higher quality, more liquid ones first. And if you're left in the fund, as everyone knows, you may not have the best things left. I know that's a very general comment. It could get very specialist. But in a sense, the panic that we're seeing in selling is entirely understandable once the panic starts. And that's what happens when you try and distribute very broadly. Sorry.
But the point is, I mean, with the limits itself is so you don't have to sell assets, right? That's what all the asset managers have been telling me. I mean, we have that 5% limit, so we don't have to be forced to sell assets to meet the liquidity. And on the European side, what you say is right. We're much later to the story, and that means a lot of these funds still have their soft locks in place, so people actually cannot leave. Some of them have 1 year, 2 year, 3 year soft locks, so they cannot redeem yet. So they're going through this cycle being stuck in these funds, otherwise they have to pay a fee if they wanted to get out.
Should we move on to story number 3, which has got a bit of a private slant to it as well. This is, I don't think the show would be complete without talking about SpaceX, right? I mean, we have to.
Sadly,
yes. We have, sadly. But it's incredible, right? This the $1.8 trillion IPO and the implications this has for the passive market.
Well, I think the first thing, when you look at SpaceX, most people that have talked about the valuation of SpaceX have set a valuation that's very far below 1.8 trillion. Obviously now it's over 2 trillion because the price action we saw the first couple of days. So it is very difficult to get to that 2 trillion valuation. I published some work last week, and you've got to believe some pretty outlandish things to get to that 2 trillion. Broadly, you've got to believe that Elon Musk is flawless in everything that he does, which, we could debate. But anyway, so you then have this extremely high valued business drop into the passive funds of potentially millions of investors around the world. And this is a long way from what Jack Bogle and others thought about when they set up passive investing as being long-term, very diversified, having your share of corporate America, as he would have thought of it back in the day, when we've already got a very concentrated market in terms of the US and also globally now in all the tech stocks. And now you've got something that's extremely expensive by almost any measure, dropped in as a very large company, and some index providers are adjusting their rules to accommodate it. It makes sense from their perspective, because otherwise people say, well, your index isn't complete. You've left out one of the biggest companies in the world. But nevertheless, this is, I think, not what people are expecting in their passive portfolio.
No, a little bit negative there, Dan. Let's bring Celine in, because
Oh, I can be more negative.
I mean, this is a great moment for private markets. These private firms. This is what we can do, guys. We've made so much money from this, and this is kind of why you should be investing in these kind of companies.
Yeah, they have mixed feelings. I think they have made a lot of money. That's true, and it shows kind of why you should start investing while companies are private before they list. But there are 33,000 unsold businesses sitting in private equity portfolios. A lot of them are from 2020, 2021. They haven't been able to sell, that were bought at the height of the market with peak valuations, and they're sitting in portfolios and they're not being exited. And I don't think they will want to take them public, because who's going to want to buy some of these businesses that might be disrupted by AI? So there is a bit of a cautious kind of optimism, let's say, among asset managers.
So one final question before we wrap up. Probably a really silly question. I'm going to ask you first, Dan. Have you bought any shares in SpaceX?
Oh, I haven't.
You haven't?
I haven't. No, my son did say to me, Dad, if you think it's so overvalued, why aren't you going short? And so I had to explain market momentum to him and how much it could cost me before that short works. So no, I haven't gone short and I haven't bought in.
Celine, Jeremy, have you bought shares?
I haven't bought shares. I do own a Scottish mortgage investment
Same.
trust.
I put it in my daughter's ISA, actually,
So
Scottish mortgage.
you're a forced buyer.
Probably we should be selling it right now, but I'm not going to.
No, but they say, okay, right, well, I think, to steal a line from a famous rap song, don't believe the hype.
Oh, nice.
Thank you all for joining me this week for another excellent show. And that's all we've got time for today. And we'll see you next week for another edition of Heart of Wealth.